Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Friday, August 25th, 2023. S&P 500 currently sitting at 43.94. I'm here with the NIL booster for the South Carolina Gamecocks, Ian McMillan. I'm David Zarling. We're on the precipice of college football.
We are.
Which is a beautiful time of year.
College football starts tomorrow.
I know. I almost freaked out last night because I flipped the Roku open and I saw Ohio State, Nebraska, and I'm like, how could this be? It was a replay.
But tomorrow,
who's the
Saturday,
Gamecocks?
August 26th. Gamecocks don't play till next week.
Oh, okay. But college football in general opens
college
up.
Football, it's a smaller. I mean, there's like 7 games tomorrow. But like next week is the official week 1 where we get like Thursday night football, Friday, Saturday, I think even Sunday. And Clemson and Duke play on Monday, the September 4th.
Okay.
So like next week is the official kickoff. But this week, I mean, you get some good Notre Dame plays this week.
It's a good time of year. Like, you've got the playoff races for baseball. You've got your college football. You have nights that are starting to cool off because we're heading into autumn.
So you hit the nail on the head. So what I was going to bring up is we're getting back to a little bit of crispier weather.
Yeah, I like it.
My wife is excited. We haven't used the fire pit in 2 months.
Yes.
Because it's been ridiculous. And my wife is
still
like,
hot.
What I'm going to do is sit outside with a glass of wine by the fire.
Yeah. Why would you?
We're so close, hon.
Why would we add heat to heat? Let's let the evenings cool off, have a fire. We're in the same spot. I just threw a new stack of birch wood on the stack.
There you go.
Let that cure up. I mean, the birch BTUs, man, they bring the heat.
Okay.
I'm excited for this time of year. At least in the upper Midwest, our lawns really get
really
dialed.
great.
Yeah,
really
dialed.
lush right now.
Yeah, real dialed in the autumn. I don't know what it looks like for you, but
we've hit some hot. Like it's been hot.
Oh, bro, yeah, so hot.
So I feel like we're making it through the end here. I'm gonna give myself a B. I'm gonna give myself a B plus, A minus on the lawn this summer.
Okay. Why not A plus?
A couple things I could have done better, but it's okay. We know how to prepare for next season. It's actually big lawn season right now. So overseeding, aeration, all that, prepping for next spring. A lot of that happens in September.
Yeah, that makes sense. Are you doing some overseeding?
I am, yeah. Yeah, I'll do the aeration and overseeding. Soak it, 3-4 weeks. Got the sprinkler system so we can get her all dialed in.
I mean, how can anybody say America is in a bad spot if we've got apps that operate our sprinkler systems?
It's amazing.
It is. It really is. I don't know what grade to give ourselves. I've done the duty as a dad of handing over some of the lawn care to my sons. And so
now Eli's probably going to be handing it over.
Yeah, it
all falls on Micah.
Yeah, it already had. Micah, he gets a little bit of a payday per mowing.
That's good.
Yep, allowance, and he's done a good job.
What is he a saver or does he like to buy things?
Currently a saver.
Okay. Ooh, okay. Saving up for anything in particular or just the natural saver?
Natural saver, but he's kind of a shoe guy like his dad.
Okay, sneakerhead.
Yeah. He was even trying to negotiate for some NMDs at the last school shopping. We didn't let it happen, but it's good. It's good to have those first jobs.
I need to know what an
Adidas NMDs. It's a type of shoe.
Oh, you have some of those?
Yeah, I do.
Yes.
I'm a fan, but I was turned on to them by my kids. But yes, Micah's in charge of the lawn. I still do the weed whacking, and Mom keeps us on schedule. Autumn is just a great time because the grass turns out great.
It does.
It just, it holds that dew. It's football season. You got to keep those cleats.
It's like spring, honestly.
100%. We probably just set a record for intro of not talking about stocks.
We have not talked once about the stock market.
Yeah, and that's okay because people are probably super intrigued about our lawns.
Or they've logged off by now.
or they've signed off, and that's okay.
If you're still here, I thank you.
Yep. And it's about to be the best episode you've ever listened to. And I don't mean that from like, I know markets have been weak in August. There's no getting past that. You know, when we
Falling
look
in line with seasonality.
Yep.
This is not a shocker on anyone's card.
Yep. We don't get to sit there and be like, oh my goodness, I can't believe we've had a 3-week, 4-week pullback that matches seasonality. In fact, we've only had one positive sector for August, and that's energy, and that's barely positive. When you look international in things that are dollar denominated, there's only one area that's close to even, and that's India. The rest are negative. So equities in general for August have been negative.
A small cap India, I don't know what's going on, but they show up like every day on New Relative Highs.
Right. And bonds in general, whether you're using like an aggregate bond, negative for the month. Treasuries, negative on the month. If you look at something like iGov, which is an international treasury bond proxy, negative on the month. When you look at commodities, you know, using something like a GCC, negative on the month. Oil's been positive for the month. That matches, right? We just said energy is positive.
It just never seemed to. They tried. Oh, was it a couple weeks ago? We tried to kind of push that, trying to get into the 84s, oil back down into this 82 to 67 range. It's now we were complaining. No, it's not like I'm saying I want to go pay more money at the pump.
Right. What are you guys in Carolinas?
Oh,
on a per gallon?
I don't pay attention to that. I literally couldn't tell you what the price of gas is, and I got gas like 2 days ago.
I'm the same. I don't really pay attention, other than my family tends to talk about these things.
Okay,
we're around I think we're around 380 a gallon.
We are. Google says average in Charlotte right now is 334.
Okay, guessing there's a tax difference there.
It is. My entire life, it's been cheaper in the like upstate South Carolina, North Carolina. There's something my dad told me years. There's some reason it's cheaper in this part of the country, like this particular region.
Maybe you're close to a refiner. Maybe you're close to a hub.
Some type of hub. Yeah, exactly.
Makes sense. Your dad's a pretty smart cat. I mean, he almost bottom ticked ADPV, so he's a smart cat.
He did.
Yeah, it's a pretty smart cat. Not that he likes cats. I have no idea. But
he actually loves cats.
Okay, fantastic.
That's all I had growing up.
That's great. So market-wise, August has been weak. Like you said, matches seasonality. Let's not get our undies in a bundle. These are things that, you know, markets have normal counter trend moves within uptrends. The uptrend thesis is negated below a number, you know, like 4,200, 4,180 on the S&P, which we've talked about ad nauseum. The NYSE, you know, you highlighted a couple of weeks ago, the 16,000 level. We are below that level and trying to stabilize around 15,770. There's other areas, whether you look at, well, let me do this. What are you seeing out of things like small caps or micro caps? Because we've spent some time talking about the New York Stock Exchange Composite, the S&P 500 in the past few episodes. What about small caps, though? What about micro caps? What are we seeing out of those areas?
I mean, Rumpelstiltskin, man, you could have gotten to sleep for 18 months. Russell, they've gone everywhere. We're still in this range. We peaked July 31st. Looked like Russell wanted to go to it. Like we were going to, you know, I think that was, I've got IWM pulled. I think that's 19,000, right? That we were trying to kind of 2,000. So 2,000, we're trying to break 2,000. And to give you an idea of how sideways it's been, we're at a flat 200 day. And you got to go pretty sideways to get a flat 200 day. It takes a lot to flatten that thing out. And as we know, one of the biggest mantras, JC Perez will tell you the same thing. It's flat 200 day, really hard to be involved in things that aren't showing some type of definitive longer term trend.
Yeah, it's a hot mess. Like it
is a hot mess. It's not horrible. We haven't broken any new lows. I mean, you're just spinning your wheels. That's
by the very definition of a flat 200-day moving average is for the past 200 trading days, your average is 0. You move nowhere. And that's what we have with the.
And we've been flat all year. I mean, we've been flat. This started flattening out mid-January.
We've been in a range since April of 2022 in something like IWM or small caps. And that, by very definition, and that range size, by the way, is approximately 19%. So you're in a 19% range for that long of a time. That's beyond 200 days, and you've got a flat 200-day moving average. We don't get to be surprised by the trend in trendlessness. And that's what we have right now is now, does IWM and small caps hold its 200-day moving average and move higher from here? That would be welcome. That would be a constructive.
Your risk reward, right, is not horrible. You would know within 1% whether you were wrong or not.
Right. And we're sitting right at the volume weighted average price from the COVID lows in Russell futures.
Wow.
The range of, the Russell 2000 being between 1660 and 2000, that wraps around that volume weighted average price since the COVID lows. And do we continue to wrap around that? We could. Do we continue to correct? And this consolidation was actually just further distribution. That would be the most ominous thesis, which we wouldn't know until we're closing below 1700 and 1650 on IWM or the Russell futures. And if we did that, that would be huge information. But for right now,
Anchor VWAP.
Yeah, all the way.
Trading View. If you're listening, if anyone from Trading View is listening to this, stop changing your layouts of where you put your indicators.
Yeah, right. Like it takes you a couple menu clicks.
Yeah, and it's anchored VWAPs under one thing, and then a month later it's under another. Drop down, and then you gotta go. Same thing with they change lots of stuff, but I digress.
And Trading View is awesome. It
is awesome.
It is awesome. We're just being picky, but his point is valid because the first time they switched where anchor VWAP was, volume weighted average price was, it took me a hot minute.
They changed a bunch of stuff. They just need to.
Yeah.
It's good. It's good in 2016.
Yeah.
Yeah, you're right. This anchor, I mean, what? That thing, look how flat that thing is.
Mm-hmm. And all we've been doing is digesting supply and demand across that area. The volume weighted average price is around 1870 on the Russell 2000 futures. And all we've done is wrap around that for well over a year. And that's happening in an environment where large cap areas have actually moved higher. They've also corrected in August. That's not what I'm saying. But from a relationship standpoint, you look at small caps versus S&P 500, the horizontal level here is super important.
I've got that pulled up. I mean, we are at COVID lows with the divergence, big consolidation. Whichever way this breaks and confirms, I think it could have weeks and months of impact.
Mm-hmm.
I mean, if we bottom here in small caps, now I'm talking from a price perspective, relative chart, I'm expecting some type of breadth thrust then.
Yeah, 100%.
Coming out.
Yep.
I'm expecting it's like back-to-back 90s or 90 to, and when I say 90, I mean 90% up day for the New York Stock Exchange, or like the 90 back-to-back 80s, some type of combination. I mean, you can get, is there a difference between 90 and 89? I don't think so. But so some type of breadth thrust. There's a bunch of ways out there to articulate that or quantify that. But if we get some type of turnaround, like a real turnaround out of the Russell here, relative strength, I would think that would kick off. And I guess we had some breadth thrusts back in
January.
Yep.
But we had the 770, right? You had the Whaley breadth thrust.
I remember the Whaley.
Breakaway momentum. So you had three massive measurements. And what's interesting about when those measurements happen, historically even speaking, is that you do see some type of pullback, which we saw in March. And now do you see confirmation in the months coming ahead, right? Because a thesis that would be out there that matches the seasonality that we're seeing is weakness in August, some rotation in September, and that the final part of this year, we see a resumption of the uptrend.
And I think that's where my head's out. Are we trying to set up for good prices going into October?
Right.
That's kind of in the back of my head.
Yeah. Especially if we hold some of these relationship lows. So you were talking about small caps versus S&P, really important horizontal relationship level going back to the COVID lows, even IWC representing micro caps right at COVID lows. Do these hold? And we're seeing rotation heading into the final part of this year, knowing that August and September are weak and rotational, but this final piece heading into October, November, December, we see a resumption of the uptrend. That would be perfectly normal when we consider where we had been going into the end of July with extreme measurements of distance from a 200-day moving average on even something as simple as the S&P 500. That you would see this consolidation take place. Now, everything I just said is worth nothing if we're back below a 200-day moving average or back below 4180.
4180, don't say that, Dave.
I know. And small caps, it would be the same thing. If we're breaking lower out of this range, if the step one would be we're breaking below 182, which is the 200-day moving average, and then we're breaking 170, 165, which is the lower part of this range. Now we have something else on our hands that I'm not here to tell you what it is. There's always uncertainty out there. There's always market narratives about this thing, that thing, the other thing, retail credit,
mortgage rates,
the dollar,
Jackson Hole.
Yeah, the BRIC countries are making their own currency. We've got crypto trying to be its own federal central currency. Like, there's always going to be that. Like, there is no such thing as all clear in markets. And I hope by now investors have figured that out. But one thing that would give us a clue that a new down leg was underway is if we're breaking below 200-day moving averages and we're breaking what had been previous support, which on something like IWM is between 165 and 170. On the S&P 500, we mentioned that 4180 level. You mentioned that New York Stock Exchange Composite for several episodes. You know, if we're breaking below a 200-day on that, below 14,000, below 13,500 on the NYA, we got a different situation on our hands.
We do.
But we're not there yet. And
we're not now. I mean, all intents and purposes, all those things you mentioned, other than before I say this, we have higher highs and higher lows.
Right.
It's outside of the Russell.
Right.
And maybe what's the Dow look? I mean, Dow, yeah, we do have the Dow never.
Dow's an important horizontal level.
It is. It could still hold here. I wouldn't call this a failed breakdown yet.
No. Yeah. Failed breakout. No.
Or failed breakout. Yes.
Yeah. No. Yeah. Correct. It is not. It is a retest at this point. Retest means, for those who might be new, it's just an area where sellers had shown up before, but now we've broken above that level, which actually happened in July. And now we're retesting the 34,300 level, let's call it, on the Dow Jones.
Yeah, this would be pretty standard textbook.
Mm-hmm.
I'm not saying it's pretty, but, hey, we also didn't the Dow go through some crazy streak of like 11 straight up days, 14 straight up days?
Yeah.
So it's only appropriate that you probably give some of that back.
Right.
If not, looks like they've given all of it back or close to it.
And
that's unfortunately how it works.
And this is happening in an environment where we've seen the trade-weighted dollar basically since mid-July move higher about 4.5%, just shy of 4.5%. The common mantra or thesis is stronger dollar equals weaker equities. And while in general that's true, I know Louis Spector.
That's what I was just going to say. Didn't Louis have kind of a piece on this?
Yeah, Louis did good work on this. Louis is someone we have respect for. He's a technician. His articles talked about what does this look like when the trade-weighted dollar, crosses above a 200-day moving average or crosses below it. Right. And this goes back to kind of debunking the thought that a stronger dollar means weaker equities. It doesn't always have to mean that. In fact, in his work, it kind of shows that there are definite periods where dollar strength, there are periods where equities are strong too. Like some of the best S&P 500 gains have happened where the S&P 500 has been strong.
Sorry you weren't able to own China or emerging markets, but
right. It's a balancing act, right? There's been really strong periods like 1983, 1995, 96, 97, 2011, 2012, 2001. Now, there have been periods of dollar strength where equities have been weak, like 87, 2001, 2002, 2008. But really, when we look at dollar strength above a 200-day moving average, it's not a death knell, is I guess the point. It doesn't mean that equities have to pay a huge price if the dollar is strong. Right now, we do have DXY above a 200-day moving average. It's above an important 100 to 101 level on trade-weighted basis using DXY. We can't sit here and say it's in an uptrend. Again, it's another instrument where you could argue it's a falling 200-day moving average, maybe even flat, and still below important horizontal levels like 105. It's not concrete on directionally what the dollar does versus equity markets. It is 100% true that equity markets have been weak in August. That matches the seasonality like you were talking about before. Dollar has shown strength. But what is interesting during that dollar strength is when you look at really dollar sensitive areas, like, for example, Latin America or something like Argentina, they haven't corrected massively during this dollar strength. So that's something to pay attention to. Something from our show notes here, Ian, that
you're not going to cry for Argentina.
No, I mean, I might. I'm just not going to do it on the show.
Madonna would be.
I might pull off to the side of the road.
Shed a tear.
You shed a tear and.
Quick tear.
Yeah. And when, the officer approaches me, why are you pulled off on the side of the road? I'm just going to tell him Argentina. Sorry. It's beautiful. On our show notes, you talked about, or you have a note here regarding the fourth quarter of 2021 necklines.
Yeah. We've touched on this slowly. I would say the Q4 2021 necklines to the upside, I think, are slowly approaching the importance of 4180. Like that's the next big. We want to make another big push higher in the indices. Let's get through those levels, and that's where we stalled off at earlier in the month, late July. So S&P, that's your 4554, we'll call it 4600.
Okay.
NASDAQ, I will call that like the 15,600, 700.
Okay.
Somewhere in there, maybe six. Like these are ranges, right? So as we know, Dave, you're always good at pointing out, we are technicians who work with pretty fat crowns.
Yeah.
Not a fine tip pin.
Yeah, we're not using pencils and pens. We're using crayons.
We're using crayons. So we've got ranges in here. So those two, obviously we've talked about, the Russell never made, never really made it back to its neckline, which went on for like all of 2021. That just wasn't a Q4 thing. That was basically after we peaked in February, March, just hovered above that. Was it like 2100? You want to call it? Dow, it's not as a clear cut neckline.
Right. Yeah, I would agree.
Others, but then I could also say, if someone had a gun to my head and made me draw a neckline, I might even put the Dow above it.
Right.
Which is this 34,000 level.
Yeah. And so Ian's point, if you're new to this concept of neckline, just so think about like a collared shirt, right? We can see that in price. We can see when price is above that collar line and when it's below. And when he's talking about the NASDAQ 100 and this, I'm using QQQ, this 380 level.
Yep.
That's where the pain started back in 21. Same with the S&P 500. I look at the 4,600 level. That's a neckline below that collar is where the pain started. And his point about the Dow Jones, interestingly, is that the neckline's a little lower. The neckline's around 33,800, 3,400, and we're still above that. Is that your point, Ian?
Exactly.
And so we don't get to be really surprised about the supply or the selling that happens at these levels, which is what we've seen since the end of July, is the return of selling in this environment, which matches the seasonality. We are experiencing price reactions at normal levels. I'm not saying they feel good. No one, like, this goes back to, would we love to be able to grow accounts in a straight line? Absolutely. That'd be fantastic. But the only person that I know that's been able to make an account grow in a straight line is Bernie Madoff.
He was so good.
Yeah. Like, he could falsify those statements like the best of them.
He was truly one of the best ever.
Yeah. So growing accounts in a straight line, I'm going to argue 99.9% of the time, fraudulent. If you're dealing with markets don't move in a straight line. For example, August, only one sector is up single digits. Energy, you look international, nothing is positive. You look at commodities, oil is slightly up. You look at bonds, they're negative. For August, nothing has been positive with the exception of some energy, pockets in oil, and that's perfectly normal when we're heading into these necklines.
Yeah.
In this final part of the podcast, I kind of want to touch base with you, Ian, on some of the charts that you've shared. Something like utilities.
Yeah.
Versus the S&P 500, right? Because utilities, I mean, in general, it's pretty safe to say are pretty sensitive to rates.
They are.
And so do you want to talk about rates, utilities in relationship to the market as a whole? Anything that you're seeing there that sticks out to you?
Well, so utilities, I guess there's two paths. So utilities seen as a defensive sector. So you never really want to see, there's a big asterisk. It's
I love that.
A broad rule of thumb that you don't want to see utilities outperform, or it's bad for the market. Now, I can go back to 03 to 07, where I think utilities, right, we had a pretty clear, well, that's a whole nother, was it a bull market or was it because we never made, that's a whole nother argument. We had a 4-year rally in stocks where utilities, I mean, they did, I think they might have doubled the S&P during that period. I think.
Wow.
I say that off the top of my head. Don't hold me to that. But I think utilities had an extremely good run from the dot-com lows through before, obviously, the financial crisis. So if we go back, in fact, let's pull this up. I've got it in front of me. Thank you, Koifin. So S&P during that run, so we're going to call it March 03 to October 07.
Okay.
S&P up 45%. Utilities up 115%.
Wow. Okay.
It's not the worst thing, but the environment that we have been in is that utilities have been underperformed.
Right. 100%.
So you see them bouncing here. So we're coming back to in this relationship, late 2020. I mean, it's bottomed right after S&P bottomed on an absolute basis. So like early-ish November, S&P, pretty significant outperformance, 38%. So we've given all that back. So we're back to that same
spot.
Excuse me, utilities outperformed by 38 from November 2021. That was Q4 necklines we talked about.
Yep.
And so we're back there. Can we push through? We seem to kind of be bottoming here with the divergence. There would be the current mantra that you don't want defensives to outperform.
And I think utilities is that balancing act of, is it defensive or is it rate sensitive? And the answer is yes.
Yeah. We got rates breaking to new highs this week. Now they've given a little bit back.
But the 2-year yield is right there, and the 2-year yield tends to be the leader. And
we know utilities, right? That's the kind of the dark cloud on utilities with rates is that of all the sectors, they kind of issue the most debt.
Yeah. Oh, shoot. Yeah.
facilitating
Could you imagine personally issuing as much debt? I mean, there's the government, there's utilities, and then there's like individuals. Like,
yeah, utility companies issue a ton
so much debt.
So if going forward, that just gets more right. That's the 30,000 foot view here. Well, that's just going to get more expensive,
Right.
and don't worry, they will pass that on to you, the consumer.
Yep.
They will pass it on. You will be paying for that debt.
Yep. Congrats.
We all will, because I got to have utilities. So
yeah, I mean, we do live in the greatest country in the world where we do get to refrigerate our food and keep our houses cool during extreme hot weather. So I ain't here
to flushes, because I remember it wasn't too long ago. Not everyone was pooping in toilets,
right? Or even being able to take a shower.
Yes.
So I ain't here to slam on utilities or water companies or municipalities or anything like that. It's just that when you look at utilities on a relative basis versus S&P, this is what Brian Shan would call an area of interest. It's a relative low that goes back. It's happening at the same point that our rates breaking out higher. If they don't, we could see utility strength here. Now, the question becomes, if you see utility strength here, does that mean defense on? Is that just an interest rate?
Or is it a value? Like, is it
a... Right. Is it value or interest rate expression? And they're just not moving lower while the market moves higher.
Let's say this. We're looking back in 6 months. We get a bottom in this relationship and a failed breakout in rates.
Yeah. Makes perfect sense.
Coincide together.
Right. And it would be a defensive sector moving higher, but do we see other, because you could argue tech is interest rate sensitive. Do you see other areas of the market move higher faster? And yes, utilities are moving higher, but they're just an opportunity cost. Like, you can own them, but
you can own them,
but you could maybe get some more return elsewhere. And that would be information as well. It's interesting.
And we know, right? Like, so recessions, I'm going to stay on this soapbox for 2 seconds.
Yeah, go for it, man.
We know it's a common theory that recessions actually really start when you start lowering rates.
Yeah.
So when the government basically says, oh, we went too far, sorry about that. And the market's like, oh, crap, they went too far. We tightened this too much. So I wonder if that, like, do we get a double top here? Now, long term, we talk about years. I still think there's plenty of evidence that we're going into a new rate cycle. When I talk about months, could this be a double top in rates? Yeah.
Yeah, it could be.
Everyone on Twitter has seen this same chart for 2 years, this broken trend line in rates going back from the peak in 81. We all know, you know what I'm talking about?
Yep. We've got this 35 to 45 year trend in rates, and it's now reversing. Yep.
If we come back to test that trend line, that brings rates back to like in the twos, the higher twos, 2.7s, 2.8s. If that happens, I think there's a thesis out there that, wow, if 30-year treasury yields go back to 2.8, what a boost for the economy that would be.
Sure.
And I am not sure that how it actually unfolds, especially if it is a Fed mandated.
Yes,
we're going to lower rates because we actually tightened way too far.
Right. It's not a market dynamic. It's a Fed dynamic, meaning you're saying an edict from the top.
Yep.
That it's a liquidity issue. Whereas if it's the market dictating that rate, that's appropriate.
Then that's appropriate. And we're like, yeah, lower rates. Let's do this. There's the risk in individual companies does not, what's the word I'm looking? It does not justify these type of yields.
Right.
This is the thing. We tighten. Stocks can do fine. And once the Fed decides, oh, we're actually going to loosen rates, that tends to be when the market says, okay, the party's over.
Right. Yeah, TBD. I mean, it's to be determined as far as what this all means, but I see your point. We haven't even touched base on the rate of change of rates. If we get a stabilization in rates, rate of change, where we just at these levels, which we're right at important horizontal levels, we just consolidate.
We stay here for 5 years, and people are like, okay, this is
Yep.
kind of used to it now. We got it. We get it. This is what we're going to have 5%, 6% mortgages.
Yep. This is the cost of money.
Normal.
Yep. This is the cost of money, and markets do well because that's the cost of money.
Now we get IPOs to become public before they're worth $500 billion.
Yeah. Yep. Because now we're going to capital markets appropriately because we're not going to the debt markets first. You're always going to go debt markets first, but
they will, yeah.
But you're not going to be sitting there just
milking every last penny out of Uber before you decide to flip it to the public bag holders.
Right, exactly.
Or Peloton, right?
Oh, yeah.
Peloton. I mean,
that's amazing. Ooh. Yeah, talk about that. Talk about Peloton. That's that's actually the
2020 winners.
That's a poster child.
And yeah, a lot of 2020 winners. ARK has rebounded. There's been some. DraftKings has rebounded. There's some things out of 2020 that have, they got their butts kicked in for 2 years, but they're stabilizing, they're building bases. And Peloton is just not one of those.
Right. I think that's a great example or poster child for the dichotomy between credit markets and public stock markets in raising capital. Because when you look at something like Peloton, its peak was January 21 from an equity standpoint.
Yeah.
And when you look at junk bonds overall or these initial public offerings credit-wise, I mean, the first quarter of 21 is a peak in credit for new companies. And so Peloton's a perfect example of that situation.
Yeah.
And how many times on this podcast have we talked about January and February of 2021 being the peak of the average stock? Yes, I understand the S&P 500 moved higher from that point into the beginning of 22. But for many stocks, January and February 21 was the peak.
Everything that was hot in 2020 off the lows, was done by March.
Yep.
Best case scenario went sideways.
Right.
Like the index. And then, but for most of these, the hot names, I mean, pick one. We talked about DraftKings. We'll use ARK as a basket of what was hot and then turned into what was not hot. Right. Now, ARK itself has, I would say, pretty nice base. We had kind of this attempt to break out in July, and that's since failed. So we're back below $45. But Peloton.
Well, Peloton's 96% off the highs. That requires a almost 29,000% return.
You'd have to turn $4 into $100. There are beyond once in a lifetime odds to do that. I'm going to tell you that right now. And I say that not as a hobbyist. I'm saying as someone, if you dedicated your entire career to one trade to turn $4 into 100, and even if that happened, I can guarantee you there's an 80 to 90% drawdown in there somewhere.
Right.
You can say, well, Amazon. I can tell you Amazon had some horrible years in drawdowns before it turned into what it did.
Yep.
And that's kind of the poster child of, if you had bought Amazon at the IPO, 99% of people are not going to stomach what Amazon went through.
Yeah, because there's multiple 80 to 95% drawdowns in Amazon.
And like, well, yeah, you're right. No wonder it went through. They sell books online. How dumb is that? No wonder it went down 95%, right? And then it turns into what it does. But most people will never be able to stomach that.
Right. Okay. Are we talking about an Amazon, a viable company, or are we talking about AMC?
AMC.
So you got to decide, right? We don't get to have our cake and eat it too. Is this an Amazon or is this an AMC? Because I would make the argument that there's no chance that AMC is an Amazon.
No. And I'd like to think that scam has run its course.
You have a theory.
Exciting. Yeah. That was darling of the meme stocks.
You got a meme stock that's in theater and movies and entertainment, and they spin off this APE, this ape trading sequence, which is no longer trading anymore.
It is not.
And AMC's just been crushed.
And they convince these shareholders, they literally vote to dilute themselves. In my career, it has been the biggest slow motion train wreck. And the fact that we actually get to watch it play out on social media, I think is fascinating.
Right. It is. It really is. Like you talked about.
Downtrend though, right? Been in a downtrend for over 2 years, about 26 months.
Wild.
I mean, could you have been in at 165 right now? And they did a reverse split. And I'm going to tell you right now, reverse splits for a company, never a good sign. It's never. I've never seen a situation where a company does a reverse split and that's what fixed their stock behavior.
And that's where we're at for AMC.
So we're back to about $13 today. This is really about $1. I think they did a 14 for 1, something like that.
Oh man.
And they're at 12. I think it's a 14 for 1. Because they opened this morning, $16. Maybe it was a 13 for, it was somewhere in there. Then this goes back to the narrative thing. Instead of trend following, it's a big story. Lots of people in the media all over this. It was supposed to be a stick 'em to Wall Street, right?
Yes.
And I mean, it's trends.
It is trends. And it's one of those scenarios where can you see an environment 24 months from now, 2 years from now, where all the documentaries come out about AMC?
Oh, yeah.
I see it.
Well, they already had the one on GameStop.
Right.
On Netflix. Isn't that King of Stonks thing about what?
Because AMC, from a technical standpoint, just this week is down, is this right? 65%?
Yeah. Oh, yeah,
AMC
this week?
So AMC is down 65% this week. We're at the COVID lows. And this is where, the retail investor, and I got to be careful here. I'm not taking the side of Wall Street versus the retail investor. I'm not taking one side. I'm just saying markets are markets and they're hard. Like we've seen ETF closures of strategies or lack thereof because markets are hard. And here we have AMC down 65% in 1 week. And this was supposed to be the flag waving central location of retail versus the big guy. I'm not saying the big guy won. I'm just saying AMC, there's going to be documentaries, maybe a book about this because there was some fleecing that went on. And no doubt about it.
The GameStop one, I misspoke. It's called Eat the Rich.
Okay.
Which was their bag. Look, we stuck it. No, you didn't stick it to anyone. You didn't. This meme stock thing has turned out to be a big. I mean, look at AMC. You can all look where the average person bought this at and see how far underwater they are. I got anchored VWAPs. I got average volume. I mean, your average person who got involved in this after it was up hundreds of percentiles is vastly underwater.
Yeah.
If they haven't thrown in the towel, which would have been the appropriate thing to do.
The worst thing you can be as an investor is stubborn, unless it's stubborn to a process.
Yeah. Oh, yes.
Right. But if you're stubborn to individual stock and you've personified it, meaning you've made it material intimate to yourself, that's a problem. And AMC was that.
I mean, if you've got $10,000 liquid money and you put 6,000 of that in AMC, that's a big chunk, right? That's just super important money to you.
Yeah.
And I think that's what a lot of this was going on. It was a get quick rich idea.
It was cultural tribalism.
How could I become a millionaire off $5,000?
Right. And I'm going to stick it to the man.
And I'm going to show them, screw you, Ken Griffin, and your billions of dollars. I'm smarter than you. You're not. And you don't have as many resources as him.
No, and they just took your money.
And they took all your money.
Because you got stubborn on one stock that was in a downtrend since 2021. And this is where we have to use charts. We have to use the visualization of supply and demand. It has to be a part of our process. Because if we rely on our emotions and we rely on the narrative, 99 times out of 100, we're going to be misled.
Yeah.
Whether from ourselves, because let's be honest with each other, who of us has not been dishonest with ourselves? So if you as an investor, I'm sorry that you got your butt kicked by AMC, but I'm also not sorry because that's how we learn and understand who we are.
How we learn.
Yep.
And to sit there and say, oh, right? I mean, a lot of this has been pushed by me. I mean, you can't sit there and say, oh, the media is corrupt when they talk about politics, but they're not corrupt when they talk about the stock market.
Right. They're only corrupt at this part, but not
Yeah.
at this part. That's a great point.
But when they've got me in on this big get rich quick scheme, I'm going to go all in. They would never BS me on this.
Poppycock. 100%. We are an interesting bunch, us as human beings. And one of the things I'm thankful for is that we get the opportunity to use charts and trends to identify reward and risk, because nothing is guaranteed. There's nothing in markets that are guaranteed, but we get to use price to identify when we might have the opportunity at reward. And going back to the original part of this podcast, as far as August being weak, there's some opportunity potentially coming up here in the final part of the year if we hold important levels. And that's the importance of technical analysis. That's the importance of using supply and demand and price charts, is we can see when what I just said is wrong.
Yes.
And do you get to know when you're wrong? And the fortunate part about the AMC situation is I don't know that those individuals ever got to see when they were wrong, other than the getting their butts handed to them. I'm just saying that charts allow us below 4180, below a 200-day moving average on something like S&P 500. It lets us know that something else is going on with supply and demand and when our exposure to markets is wrong.
Mm-hmm.
Because there's no such thing as being 100% right. My wife will remind me of that.
Impossible. Do you know how much money I'd be? How much money I'd have if I was 100% right? I'd tell you I wouldn't be sitting here.
Yeah, 100%. You'd be
on
you'd be close
somewhere.
No, you'd be in Costa Rica cheering on the Gamecocks.
I would be.
100%. So we bumped up against the end of our time. Great podcast. I think we're providing our listeners some really great information. I think anything else that you'd like to highlight at this point before we wrap it up would be appropriate, because we got to wrap it up.
Yeah, I think that Q4 2021 necklines is really your new 4180.
I love it.
Is that a range that we trade in for 6 months? I have no idea, but that's where, for me mentally, I was willing to say, I'm kind of done with this trend, and you want to get back above these levels. That's where I'm willing to that's where I'm willing to get involved. Unless, now, if we get to 4180, if we get to, look at something like an IWM on the 200-day. There are good risk-reward scenarios. We don't have to get to 4180 for this to be done.
Right. 100% agree.
Yeah, we continue to hold. We're on day 7 of bouncing off the 200-day on Russell. This seems kind of, clearly people are interested in this.
Right.
And if I'm wrong, then I probably know by Monday afternoon.
Yep. Within percents.
Yes. Within percents.
Within percents. And I guess at this point, this is a great segue, but I also like to highlight the group that supports this podcast, make sure that we can support it financially. And that's the Adaptive Select ETF. ADPV is the ticker listed on the NYSE. ADPV helps investors access two of the most prevalent factors in markets, momentum and relative strength. Through proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. With that acknowledgement under wraps, also asking our listeners to give us high rankings and sharing it with others. Ian, I think you did a great job highlighting some important aspects of the market this week. I look forward to what we're able to provide next week. But thank you again for your time, Ian. I hope everybody here has a blessed week.
Yep. Have a great weekend, everyone.